Hey, everybody, and welcome back to the Teaching Tax Flow podcast. Today, episode 141, we are diving into gift taxes. That's right, we've titled this one Gift Tax 101. But before we get into this one in any depth, let's take a brief moment and thank our episode sponsor.
Are you leaving money on the table? Are you an accredited investor seeking new and exciting investment opportunities? Look no further than Integrated Investment Group, your trusted partner in financial success. At IIG, the focus is on delivering exclusive investment options tailored to your unique needs and goals. Contact them today and let their expert team guide you toward your financial aspirations. Wondering if you qualify as an accredited investor? Visit teachingtaxflow.com/IIG to find out and take the first step towards a brighter financial future. Integrated Investment Group. Your path to financial success begins here. Securities offered through Cabin Securities. Member FINRA SIPC.
The Teaching Tax Flow podcast. We know you're excited to be here because we have a little gift for you. That's right. We're talking about gift taxes, or Gift Taxes 101, how that relates to you and how the IRS expects you to report and potentially pay on those taxes. So as we get into it, as always, right, just think about an example of, let's say, maybe you were gifted something. You had as Chris likes to say, a rich uncle potentially pass away, or just, you have a bunch of cash, we'll say left in your mailbox, or, it's your bank account. But before we get into it, as always, let's welcome back the man of the half hour, Chris Picciurro. What's happening, buddy? How are you, man?
I'm well. How are you doing today?
Good. You like how I referred to you as the man of the half hour? That means you can be twice as impactful within a 60-minute period.
We're going to try, because this is a question we get often in our private CPA practice and in Defeating Taxes private Facebook group about gift tax. There are a lot of opportunities right now with the Tax Cuts and Jobs Act for some planning, and we're recording this in 2025, so we're going to talk through the rules that we are living in right now in 2025. We're about halfway through the year, because gift tax doesn't always have to be addressed at the very end of the year. So there's a lot of confusion as to what is the gift tax, how it interplays with your federal estate tax, and are there special rules for different types of assets that could be gifted, specifically business interests and what we call super funding, a 529 plan. So we're going to talk about all that today. Obviously, you're going to want to, if you're listening to this, first of all, thank you for your attention. Second of all, you're going to want to talk to your tax professional and definitely attorney when you're thinking about doing any type of advanced gifting. Obviously, some modest Christmas gifts, slip in $100 bill to your child or grandchild is not a big deal. But yeah, you definitely want to be aware of things, because one thing to remember is that when you inherit property, that you get a stepped up cost basis. When you gift it, you inherit the giftor's basis. So it doesn't make a big deal when you're talking about cash, but let's say you have a piece of land that grandma and grandpa bought many moons ago for $100,000. It's now worth $500,000. And if they just gift it to you, then your cost basis is $100,000. If you turn around and sell it a year later for $500,000, you're paying tax on $400,000. However, if you inherit it and it's worth $500,000, your cost basis is $500,000. If you turn around and sell it for $500,000, it's reportable, but you're not paying any tax because there was no gain. So that's where the biggest mistake I see with people is gifting appreciated assets is typically a bad idea when you're talking about family members. But yeah, let's jump into this, because remember, tax agencies are your involuntary business partner, and the IRS is the collection agency for the federal government. And this might sound a little grim, but it's a lot easier to pass legislation and to assess tax on someone that's deceased rather than someone that's living, because deceased people don't vote. So you've got, when you're talking about the interplay between gift and estate tax, and there is one, that's where things get a little murky. So gift tax is a way to or gifting is a strategy that many people use to get assets out of their estate to reduce their exposure to estate tax. And is right now under the Tax Cuts and Jobs Act, the estate tax exemption is very high. It's almost $14 million per person. But that could easily get slashed by 75% based on the results of a future election. So that's really what it is. So in when we talk about gift tax, so gift tax is simply a tax imposed on the transfer of assets.
Mm.
Okay.
And I'm glad you started with defining that right too, because a lot of people might think, well, what exactly is this? Right? Like, are you gifting? I mean, who knows? We've had some very literal thinkers that we've run into, right? That I wouldn't say tend to question everything, but they do. And it's good. Gives us a little drive. But I also like going back to really quick, Chris, that you mentioned basically that, is it called a threshold really when you said, it's like, was it 13 million something? Is that the term that's used for that?
Well, that's the
Cap
estate tax exemption. So
exemption.
ultimately, remember, if your assets are over the estate tax exemption the year you pass away, and that's a moving target, that's the number that can go down, then you could be assessed up to 50% estate tax. So gifting is a way to get assets out of your estate. And it's not just estate tax. There could be people looking for Medicaid eligibility, veterans VA benefit eligibility. There's a lot of reasons you would gift assets out of your estate. So yeah, that's the thought, because if you're going to, let's say, if you're subject to a 50% estate tax, you might as well give away things to get under that limit. But again, there's a right way and a wrong way to do that. So who pays the gift tax? This is the first. So we've already defined what a gift tax is. But who pays it? And this is what's really confusing. I'd say 8 out of 10 people, or 4 out of 5, I guess it's the same thing, would get this answer wrong. The donor pays the gift tax if there is a gift tax, and or files a gift tax return if you're supposed to file a return. Most of I would say 98% of the time in my 20 plus years, probably 99%, when a gift tax return is prepared, there's no actual gift tax paid. It's more informational. But the person giving the gift, which is called the donor, is the person that files a gift tax return and pays any gift tax. The donee, or the person getting the gift, does not file a gift tax return. Now, there are special rules if you're getting international gifts. We're not going to talk about that. And we're talking on the federal level. Some states have different rules. So if you file a gift tax return, it's the person giving the gift, not getting the gift, that files the return and pays any tax, which is very rare. Again, that's something that is confusing. It seems like, well, why is someone that's benefiting from it not having to pay any tax or file anything?
I would have got it wrong. Let's be honest. I would have totally thought it would have been the other way around, because it would make sense almost, right? It's almost like getting a paycheck, right? Sure, your employee's paying tax on part of it, but yeah, I just thought it would have been other ways too.
So every year we have an annual gift tax exclusion. And what this amount is this is the amount that people can give to each other without having to file any type of gift tax return, or eat away or utilize any of their estate tax exemption. So if you exceed the annual gift tax exclusion, you don't owe gift tax. What happens is you start eating away at that lifetime exclusion based on whatever the estate tax exemption is for the year. So let's look at that annual gift tax exclusion is $18,000 per recipient per year. So as long as you're not giving someone more than $18,000 a year in assets, then you don't have to file a gift tax return. So probably 99.99999% of gifts will never file, if you think about all the holiday gifts and all that kind of stuff, file a gift tax return. But if you give more than $18,000 per recipient per year, you would file a gift tax return. You have an unlimited amount of recipients, and married couples can actually each give $18,000 to their children per year, or whoever the heck they want. So a lot of times, I'll give you an example. We run into the situations where there might be a younger couple They can afford to purchase a home as far as from a monthly income perspective, but they're struggling to get the down payment, right? And the parents can gift. Let's say the parents need to give $50,000 to a younger couple. Let's say they have a daughter and a son-in-law, and if mom just gives the daughter 50 grand, she's now $32,000 over the $18,000 state or the annual gift tax limit. But if mom gives daughter 18 grand, dad gives daughter 18 grand, and then mom and dad give the son-in-law, hopefully he's a nice guy, the remaining amount, no one's giving anyone more than $18,000, and they have $50,000 tax-free. They can use that for down payment on their first home. It doesn't have to be a first home, but I'm just using that as an example. Those are practical things we see all the time in our tax world. How to efficiently transfer money from one person to the other.
And I'm sure you guys have seen it too in the past, right? Like say there's, say there's two people, mom and dad, right?
Mhm.
And they say, oh, well, just here's a check for, I don't know, we'll just call it, 36,000. We'll just call it what it is. There you go. Here's a check for 36,000. Mom writes it, sends it off. Dad writes it, sends it off. Oh, and we'll just tell them it came from both of us. Is that how it works, or does it need to
Technically,
be-
they can elect what's called gift splitting, but then you would have to do that on a tax form. So they would probably want to write two checks. And I mean, here's another practical example. Daughter's getting married. Mom and dad want to contribute $50,000 to her wedding. That's very generous. Ooh, we got a challenge, right? So what would I recommend? Well, maybe mom and dad give her $18,000 each on December 30th. And then January 2nd of the next year, fill up the remaining amount, and a gift tax return is not filed. So there's I don't say workarounds, but I would call it planning opportunities to avoid having to file the gift tax return. However, remember, the vast majority of gift tax returns, there's no tax paid. It's information only. Now, what happens if your gift goes over the annual exclusion of $18,000? At that point, you have to file a gift tax return. That is called a Form 709 on the federal side. Again, some states conform to the federal gift tax rules, some do not. And at that point, if you did that in 2025, so John, if the parents, let's say there are parents that said, hey, I want to give my daughter $100,000. Well, good for daughter for winning the parent lottery financially. They give her $100,000. They've each given her $32,000 each is reported on a gift tax return and eats away at the $13.61 million unified lifetime estate gift and estate tax exemption. So ultimately, probably not going to be taxable, but it is reportable. But remember that $31.69 or $61 million per person gift tax, unified estate exemption, that could change at any time. So during this Tax Cuts and Jobs Act era, we're seeing a lot of very wealthy families gift money out of their estate now at that $13.61 million mark into maybe, there are advanced strategies for advanced situations, into maybe a irrevocable trust. So it's out of their estate and the beneficiaries can't, they can't utilize that money. Again, you're going to want to talk to a estate planning attorney on that. But ultimately, when that gift goes over the annual exclusion, you have to file a 709. You report the gift. You don't necessarily have to pay tax on it. It eats away at your unified credit or that lifetime estate tax exemption.
That's probably one of the best examples too. You mentioned about the weddings, right?
Mm-hmm.
There's very far and few between you're finding a wedding under 18 grand these days, especially. And I would probably say, and this is just me guessing, right?
Mm-hmm.
That there is probably maybe 1 out of 100, probably more than that look at it from the eyes of what we're talking about, right? Instead of, oh, well, it's not a gift, really. I'm just paying for it. I'm covering it for them. I'm not giving them anything, right? It's not like I'm giving them cash. I'm paying for it. So they probably think that it doesn't even need to be reported. So they're looking at it maybe as a personal expense instead of a gift, but it's actually a gift, right?
It could, right. So that brings up a good point. What is the gift? It's transferring property without full consideration, meaning I'm going to give you, you know, cash. I'm going to give you an asset for less value. Well, there are certain things that are not considered gifts. So planning comes into play. Tuition and medical expenses, if they're paid directly to the provider, are not considered a gift. So think about this. Let's say you have a college-age student. Let's say the tuition is $50,000 a year. Or let's say you have a grandchild that has some severe medical issues. And at $50,000 a year, the grandparents want to cover that, which is very generous. If they give the money to the parents or the grandchild directly, it could trigger a gift tax return. However, if they pay the medical expense directly or the tuition directly to their medical provider or the financial institute, then that's not considered a gift. So again, there's a lot of planning involved when you get in these family situations that we live in, quite a bit. And so that's why for parents, it's just kind of cleaner, and grandparents or whoever, to pay any type of tuition or medical expenses directly to a provider, not a taxpayer.
And that is interesting because, again, I bet you a lot of people just don't even know, where it falls, right? So they just think they're relieving a financial burden instead of giving a gift. Such.
Right. So ultimately, it's like this: when you're talking as a tax professional, when you're talking to clients and people, what people like to tell you the stories that are kind of irrelevant. Sorry if you're listening to this and you've told me a story over the last 20 years to the fact pattern.
Theirs was good though, just everybody else.
It was right. It's relevant to your life, but it has nothing to do with. I don't really care the why. I'm trying to figure out the what. What are you trying to accomplish? Are you trying to get money to this person or that person or that way? Just once I figure out what they're trying to accomplish, then we can make a plan to make it tax efficient. Now, I want to touch on that 709 form that I previously mentioned. The 709 form, the gift tax return, is due on April 15th of each year, just like a Form 1040, but can easily be extended for 6 months. Really easy to do. Remember, married couples can elect gift splitting, which on that 709, meaning, like you mentioned, if dad technically wrote the check for $100,000, they can on the tax return say, yeah, dad wrote the check, but we're electing that mom and dad split that gift. Now it's cleaner just for each of them to write separate checks. But again, we don't, people do things all the time before getting, the proper advice, unfortunately. But if you're listening to this podcast, so hopefully you're not going to those people.
And if you start going down that path, you go back and listen to some other episodes.
You should. You'd be smarter for it. All right, I'm going to talk about 2 advanced planning strategies because, again, there's a lot of information about gifting. We're going to continue to add on the Teaching Tax Flow YouTube channel more information about gifting. There's already some good information about estate. What we're finding is there is a thirst for estate tax planning information. Actually, John, it's interesting. Our estate tax episodes seem to get, I think, have the most listens and downloads.
I think so.
Crazy. But that's important. So we're going to add to that. We're going to get some more content up. But there's 2 common advanced planning strategies when it comes to gift tax. All right. The first one's going to be around a concept of valuation discounts, meaning, let's say, John, you own a business and you like to, remember at one point we said you were crocheting up a storm. And let's say you crocheted your way into having the best company in the Midwest, and you want and it's worth lots of money, right? You want to gift some of those assets out of your estate while you're alive. Well, or after you passed away, it could be part of your estate. Well, here's the thing: the concept of valuation discount says if you have a closely held business, without the matriarch or without one of the key people in the business isn't worth as much as it would be without them. So because there's a lack of marketability, lack of control, a lot of times the fair market value of the company equity is reduced by 20 to 40% typically.
So you're
So
saying I hold all the crochet skills in
you
my little
do.
hobby business.
So what we're saying is, if you own a business and you want to try to start transferring some of the equity of that business out of your estate, make sure you talk to the right people. There could be something called a valuation discount. So in other words, if the business is valued at $20 million with you, you might want to consider an alternative valuation. That's where you bring in, there are CPAs with just the ABV, I think it's accredited business valuator, that we look at and say, okay, is this eligible for a valuation discount, which would help the taxpayer? Much more common strategy is funding the 529 plans, right? Because a lot of times, especially grandparents in general, but sometimes parents, sometimes rich uncles, et cetera, want to fund a 529 plan. 529 plans, check out our other content, subscribe to our YouTube channel. Just put 529 plan in there. You're going to see a ton of stuff, but those are those educational savings plans. Well, some people want to put more than $18,000 a year in the plan. Well, the IRS said, you know what? We think education is important. We know we are your involuntary business partner, and we're going to allow you to superfund a 529 plan. What that means is that you could put up to $90,000 per beneficiary in 2025 into the 529 plan in 2025, and then make an election to say, you know what? We're going to spread that gift over 5 years, so we don't touch our state tax exemption. All we're doing is we're filling up that $18,000 per year annual gift tax exclusion. So there's that. If you hear about that 5-year averaging rule, that allows married couples to superfund, basically front load up to $180,000 into a college savings accounts for their kids, and not even, they'll prepare a gift tax return to make the election, but they're never going to eat away at that lifetime exemption. So that one's really common, where we'll see that happen in the real world. So going to wrap it up with just some other considerations. The more advanced or the larger your estate, the more complicated your estate. If you have real estate businesses, trusts, you obviously need to utilize different strategies for those situations. So there, as and I challenged you earlier, I don't know if I've heard it yet though, that we're supposed to have a sound effect when there's an acronym. So we're going to have more acronyms. We got GRITS, we got GRATS, we got GRUTS. These are all grant or retained trusts and all these kind of cool things that can play a role if you have a more complex estate. Remember that Tax Cuts and Jobs Act is set to expire here soon, and the exemption for the state could get chopped in half or reduced by up to 75%. We're going to see what happens with the tax laws. So that's gift tax 101.
Not too bad. I'm still caught up on the fact that I managed to needle my way into a $20 million crocheting business. I'm sure there's a different term for that.
Yeah, I'm sure you have a separate podcast for that.
Shh, that's my my alter ego. It's
needling away or something fun.
I know somebody's listening to this. It's like, it is not called a needle in crochet. You are incorrect. You are yes. I know
don't know
nothing
what it's
about
called. Hey, if you know the proper term, please go on our YouTube podcast episode, and you know what? Slap a comment in there. Slap back at us a little bit. I like it.
Tell me how wrong we are with this. This would be perfect. But yeah, no, Chris, this was a great one talking about gift tax, obviously, and I think you brought up that example of weddings. That's probably one of the biggest things, right? Like and again, I would have thought it would have been the other way around. Like, who pays the tax? Like, hey, I'm giving you the gift, you pay it. Kind of do that deal. But then I get it on the other side of the fence too. So, as always, though, we're wrapping this one up. Specifically, any questions, as Chris had mentioned too, comment on YouTube, Facebook, wherever you see this at. Drop us a line and actually tell us some examples, maybe, of things you could think of that are out there that people may not realize they are actually gifting something without reporting it appropriately. So it'd just be interesting to see what people, things that you've done in the past, or give us an alias and tell us that you did it. We don't care. It's more the context of it. But we'll see everybody back here again on the Teaching Tax Flow podcast. Same day of the week, different time of the day, maybe completely different topic. Switch it up every week. So we'll see everybody later. Have a good one. Again, like, comment, subscribe to the YouTube channel specifically, or wherever you consume your podcast. And heck, share this with someone. Give them a gift. Here's a tip though. It is worth over $18,000 indirectly. Well, you're not going to get taxed and sharing a podcast, so share with them. They'll thank you later. Have a great week.
The content provided is for educational purposes only. We encourage you to seek personalized investment advice from your financial professional. For all tax and legal advice, please consult your CPA or attorney. Investment advisory services are offered through Cabin Advisors, a registered investment advisor. Securities are offered through Cabin Securities, a registered broker-dealer. The content of this podcast does not constitute an offer of securities. Offerings can only be made through an offering memorandum, and you should carefully examine the risk factors and other information contained in the memorandum.